Hello, and welcome back to the Wallfacer Labs podcast. Today's guest is Sam MacPherson, co-founder and CEO of Phoenix Labs, the core contributors to the Spark protocol. Sam is a longtime contributor to Sky, previously known as MakerDAO. Sam, welcome to the show.
Great to be here.
So, for people who don't know anything about you, how did you wind up at MakerDAO in the first place? You joined in what, 2021, 2020, sometime around there?
Like in an official capacity, it was 2021. Yeah, my first introduction to the Maker protocol, I came into crypto in the 2017 ICO cycle. I think like most people you start investing, hobbyist investing, stuff like that. And then, I bought some ETH, bought some Bitcoin, started like learning more about Ethereum. And then after that, I was looking for DeFi is what interested me on Ethereum. And so I was looking for projects that were related to DeFi. And Maker was the first one. I mean, it was like a huge amount of the market share at the time. I think it was like, there were some other projects like Oasis Dex and stuff going on. Not Oasis. That was a Maker project as well.
That was Maker as well.
Ether Delta, stuff like that. Some like old order book stuff going on. I think Uniswap hadn't really launched in 2018 yet. So very early days, but Maker was the one that interested me because like in that time, there was just like a sea of nonsense, Dentacoin, all this stuff, right? If you remember the days. And so Maker was like, I'm a fundamentals investor. So I saw cash flows, this kind of stuff. So that's what initially got me interested in it. And then I just spent like the next 2 years just kind of quietly learning about the protocol, seeing how this whole DAO governance thing worked, made some proposals off and on through the years. And then 2020, I was actually a video game developer at the time primarily, as well as I worked on some other software projects. But yeah, towards 2020, I started more seriously looking at Solidity development. And then, around the summer of 2020, I think the DAO was kind of the Maker Foundation was handing off operations to the DAO little by little. And so I joined the Bootstrapping DAO community group. And so one of the first projects I worked on was the PEG stability module, which after the March 2020 Black Thursday event needed to be introduced to bring DAI PEG back down to $1 because it was like at some points it was like $1.08 or something. It was way off peg, and that was because too much demand. So first smart contract, it was actually like the first or second I even built. I went into production as the PEG stability module, and very quickly I already had like hundreds of millions of dollars in this, and I'm like, whoa, what am I doing in video games? This is so cool. Like you can be involved in this big financial stuff right away. So I was pretty hooked after that. And then the foundation fully dissolved towards mid 2021, and then I joined the core engineering team at that time. May 2021 is when that happened. And then so I was on in a more official capacity in Maker.
Well, to join, and the first thing you work on is the PSM, which today is responsible for how many of billions of dollars, and is pretty impressive. Something actually interesting, that I was thinking about yesterday, and the PSM maybe is like the point where MakerDAO, now Sky, but MakerDAO then, really changed as a protocol, I would say. You can disagree, but I would say original MakerDAO, single collateral, not SAI, right? SAI, single collateral DAO, exactly. Was like super out on the spectrum of idealism in terms of, this is how a new financial system should operate. And it feels like maybe at the point of the PSM is where MakerDAO turned into this very practical thing where, hey, this is the best way to run a protocol. Yes, we have to accept these more centralized collaterals. And over time, I think about MakerDAO today is this super cash flow focused, very pragmatic protocol. I'm curious how you kind of think about the spectrum and tension and relationship of some of those trade-offs that have happened with Maker over time.
Yeah, it's quite an interesting journey. I'll caveat, Maker is not a bank. Like there are important differences, but the mental model you can kind of use fits pretty appropriately. But most banks do not form by issuing loans against another collateral first, and then back or getting deposits in cash later. So that's kind of how this formed. And so DAI originally, yes, you're correct. It was collateralized by ETH. But the fundamental problem with that is that you can't scale the system where it works fine as long as the demand for people borrowing minting it and borrowing it is higher than the amount of demand for holding DAI. But that's not usually the case. There's much more demand for holding stablecoins in DeFi than there is for people taking loans. And usually they're taking loans against crypto collateral for leverage. So that the portion of that size is much, much smaller. And so, as I mentioned before, March 2020 Black Thursday event, that was the moment when the demand for DAI holding it passed the demand for leverage on the other side. And it's never gone back since. It's always been the other way. And like, there's no reason it should return. And so the choices there are like, yes, you're correct. It was sort of a phase transition, but either that was what the choice that was made, or the protocol would be like a footnote of history that was, now we would be arguing about, Frax or whatever would have just taken Maker's place.
Yeah, it's an interesting point. And I think maybe we can come back to this, but even looking just in my research for this podcast at the different websites for MakerDAO.com and kind of Sky Money, it feels like some of the direction or how the protocol markets itself have really changed as well. I feel Sky is very focused on what is this awesome use case today with the savings rate and the adoption that has sort of brought on. Do you think the two sort of missions of what was then MakerDAO, now Sky, are still the same, or have they evolved in a kind of productive way?
I mean, there's definitely been evolution, and I would say the DAO structure is actually where most of the changes have happened. But the product, though, yeah, there was a part of DAI that was like being used as like like more of a regular stable coin, like for payments and transfers, this kind of stuff. It's increasingly such that Tether is winning this non-yielding sort of US dollar as a payment, a kind of a position, and that's okay. Because of this, the positions that remain open are yield-bearing stable coins, and so I view this as the modern product these days. So that battle has already been waged, and Tether is increasingly just dominating everybody in there, including Circle. So where the next place to scope out is yield-bearing stablecoins, and USDS is the top position here. So this is something where I think there's a product market fit. We can continue to optimize and deliver what we view as the best risk-adjusted rate, and it's been going great so far. I mean, the protocol's over 8 billion in deposits. We're pretty close to all-time highs, actually, to where the craziness of the beginning of 2022 was with Terra Luna and all that stuff. So it's good we've been able to kind of grow back to this position. But yeah, to get back to your earlier point, I think the big changes are in the governance structure. So I don't think we've cracked decentralized governance for real, like in a sustainable, scalable way yet. And I think the end game plan around Sky, making the core protocol as simple as possible, and then moving all the growth and innovation decision-making basically out to these redundant SubDAOs. They're called stars, but you can think of them like a SubDAO, I think, is an appropriate word for that, where the core DAO at the top is just very basic, and the SubDAOs can be like more centralized and more like, let's go in this direction, and like not having a giant argument about everything all the time, like as in the more traditional DAO structure. And this is kind of nice because it's not like ignoring human nature anymore, which is when you have these flat structures, this has been tried time and time again, like communism, all this stuff. I think most people are on the same page about that it goes against human nature. And so it doesn't work no matter how idealistic we want to be. And so embracing the human nature, I think, is important if you want to design a system that's robust. And so the SubDAO model is fundamentally capitalistic. The SubDAOs are kept in check because they're competing with one another. So if one of them becomes inefficient due to whatever, corruption, it doesn't, like any number of reasons, it will just not be able to win against the ones that are full focus on delivering the best value to the users. So this model, I think, is the bigger innovation that's gone on. And so this is, I think, an attempt at doing scalable, decentralized governance. And, will it be successful? I don't know. But I think it's probably the most serious attempt to actually do it so far.
I agree. And all right, I've got like 4 different directions I can go with from that last answer, which is always the problem of hosting an interesting guest. All right, let's go to the SubDAOs, and then I want to put a bookmark and actually come back to the Tether piece. But as it comes to the SubDAOs, I think, I actually remember exactly where I was when I read the endgame plan for the first time. And I think my first reaction was kind of like, what the fuck is this? And then my second reaction was, okay, I start to see where this makes a lot of sense. And, to use the more modern terminology, it was kind of like a Dojification of MakerDAO, where you had this very large organization, lots of contributors, lots of expenses, and maybe not the highest sense of accountability. And the SubDAO model kind of made everyone fight for their own a bit more. And now you do have many companies like you guys that are SubDAOs, or even, I guess, like, Stakehouse is kind of an independent thing, but obviously came to existence as MakerDAO contributors, I believe. So the spin-outs and all are quite interesting. As far as I'm aware, you guys are the first one to actually go down the full star SubDAO path. I'm curious how that specific conversation came to be, like in the nitty gritty. Was it something you went and pitched? Was it something that was pitched to you? How did it actually come to be?
Yeah. So for me, I've been through this whole process. So I've seen the insides of the DAO structures, both the previous iteration and this one. And like, I can attest this structure is much better. So what I'm interested in, I'm not interested in politics and governance and all this stuff. Like, I'm a product guy. I just want to make products. I want to like get integrations and grow the protocol and this kind of stuff. So I've always been focused on this. Inside the previous structure, it was okay at first when we first started, but increasingly the amount of bureaucracy and politics surrounding like literally every decision had to go to a vote. It was impossible to do anything. You want a budget to do some small thing. If you're in a corporate structure, who's the person who's in charge of this? You requisition a budget and like, okay, great. We've got the objectives and all the stuff. You go ahead and do it. This conversation can happen like in a few days. Whereas with the DAO structure, any budget that is not like specifically to like a core unit for, you guys do engineering and you only do engineering and your budget is only for engineering. There's sort of like, there's many reasons that budgets that are like cross specializations in a company. And so having to go to the DAO for every single budget request for anything, and it takes like 2 months, 3 months. And then you have to argue with people on the internet, like spending so much time arguing with anons, basically. Like, this is just so not scalable. So my goals have always been the same throughout the entire process. When the end game was introduced, at first I same reaction, like, what the fuck is this? But then you kind of, you think on it a while and you're like, okay, actually, this kind of makes sense. There was like a lot of the issues I mentioned in the previous DAO structure. And so for me, wanting to just deliver value and grow the protocol, this seemed like a good way to do it. Once I realized there was going to be these SubDAO structures, I was like, okay, here's something that I think is missing. And in particular, at the time, there was a number of features that were not in the Maker core vaults that I wanted the protocol to have. This is stuff like cross-collateralization. LSTs were becoming very popular at the time. And so we recognized that rehypothecation was important, like especially on ETH. So at the time, like, this was just starting. So like Lido had just launched not too long ago. And then like, we recognized this looping is very popular right now, but it's like, it didn't really exist at the time. But we recognized this. And so we wanted to launch like a more modern lending market attached to Maker's balance sheet. And so this was where Spark formed. Is initially we wanted to start out with a modern lending market. And that's why we chose the Aave code base, because it was the most advanced at the time. And it had features that we needed, like efficiency mode for the ETH looping. So we launched with that, but Spark has evolved way beyond that initial use case, but we can get more into that later. So yeah, how did I pitch it? I mean, when Rune was coming up with all this in the abstract, and so I talked to him, I pitched him the idea, and he's like, this is great. Like, I'm really happy you're going to join into the SubDAO model and everything and get it all bootstrapped.
Oh, that's great. Yeah, you mentioned that the initial decision there was around the Aave code base. If you were launching Spark again today, would you still make that decision, or would you maybe take a more modular approach, or how would you kind of rethink some of that today?
I mean, the options available are much larger now, so it
Yes.
would be potentially a different decision. Like, what we did was we just looked at what are the features we need and which are we didn't want to build something from scratch because we knew that would take like a year. So we just looked, there's tons of great lending markets out there. So we just looked at what was available, and Aave v3 was just what checked off all the boxes. But there are like newer features that were missing at the time. Aave themselves have introduced this liquid modes that allows you to run different LTV parameters for different assets. So, and there's like now newer lending markets, Morpho, Euler, I miss your name. There's other ones. Fluid is another good example of a very innovative lending market. What the guys are doing at Curve, there's lots of innovation there on the liquidation side. So yeah, like lots of new stuff all around. So it would be a different decision. The options available are larger. The decision-making process would be similar, but we might arrive at a different conclusion.
Great. Yeah, I'm very curious about that actually. But as kind of patient zero for the SubDAO model, I guess, what of the experience has maybe not gone exactly as you've expected? What What has kind of surprised you, or has everything kind of been swimmingly so far?
I'm surprised at how quickly it was successful. The launch of Sparkland in May 2023. Yeah, I mean, we cracked like it was like a few months, like 3 months ish. We cracked 1 billion, and we did not even have the farming on at that point. We turned it on a bit later. There was the SBK farms, but yeah, there was like it really just took off on its own. I mean, the product I knew was quite good, but just like so awareness and people like coming on board, like it was just a lot quicker than I thought it would be.
Yeah, I mean, and you kind of alluded to it earlier. I'd like to walk through the evolution a bit of where Spark began and where Spark is today. Actually, around the time you guys had launched, we had written a blog post, I think it was called Spark Makers, Your Nation's First State or something, kind of, something of that ilk. At the time, we actually had written as well that, a big push for Spark, I think in the original vision, was more capital efficiency in the different lending markets as compared to CDPs, but to kind of supplement CDPs. Do you find today that most people interacting with the Sky ecosystem generally are coming from Spark, or actually is it still from people creating CDPs?
It depends on what they're doing. So there's multiple facets to Sky and Spark. So on the savings side, these are users who want to. I mean, there's all kinds of different users for this use case, but I would say it's pretty equal. We have two main UIs that people interact with this, and this is getting into SUSDS or our newer product that we launched, which is SUSDC, which is a USDC variant of this. We find people use both interfaces, Sky Money, Spark.fi. They're both great interfaces, and they both do similar things on this side. That interaction is largely the same. There's definitely some differentiation on the lending side. So we have the core vaults, which are now down to about 10% of the outstanding debt, and Sky is slowly winding those down because it wants to move all of this into SubDAOs. I mean, as long as people want to use them, it's fine to keep them running. It's not like they're going away anytime soon. They've been kind of tapering off over time. Spark is now most of the crypto collateralized lending, and with Sparkland, it's about it's a little over 10% of the balance sheet now as well outstanding, even in these sort of more bearish conditions, as well as we have more recent stuff we've deployed in like March of last year. We do lending against Athena, and it's mostly PTs now instead of the actual SUSDE. It's like lending against these PTs because this allows people to for the PTYT thing. It's like people are allowed to take leverage on the points farming, which a lot of people like. They want more tokens, right? And so in exchange for that, the fixed rates on those are actually quite good, even yielding like 7-8% ish now, even like when the rates have completely cratered elsewhere. So we're still have about like 500 million deployed in there as well. Yeah, what else is there? So yeah, I mean, there's more modern stuff as well. We've been expanding through our newest product, which is called the Spark Liquidity layer, which injects capital across all of DeFi, actually really everywhere. So it's like, so the Sparkland was like the first internal instance of this is the Aave fork. And then this sort of strategy of injecting liquidity into external markets just totally makes sense to scale. So now we've deployed into Aave, Morpho, Fluid, and this is also on Ethereum, Base, and Arbitrum. So we now have support for all of this. And this coming up week, we will be activating BlackRock Biddle, Superstate USTD, Centrifuge, Janus Treasury token, as well as Maple Syrup USDC, which gives access to off-chain lending, still crypto over collateralized lending, but it's off-chain, as well as, basically we just want to onboard everything so that once we hook the, maybe we can get more into the Spark liquidity later, but yeah.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built Vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
No, we can go right into that now. So the Spark liquidity layer, I think, would you see it as like the natural evolution of the D3Ms, the DAI deposit modules, where I guess from my perspective, the D3Ms were very focused on expanding DAI throughout the entire kind of DeFi ecosystem, making it cheaper to borrow, or etc. How do you view the Spark liquidity layer in that sort of same vein, or is it different? Does it have a different end goal?
Yeah, so over the years, just so if people aren't aware, the D3M module, we introduced that a long time ago. That was actually first introduced, and it was first connected to the Aave V2 market back in 2021, I think October. So the idea with this is that you would just mint DAI. Now, I think there's a misconception. People seem to think it's unbacked DAI. It's actually not unbacked. It's actually just backed by itself. It's like because you're the issuer, you have liabilities in DAI and you have assets in DAI, right? So that's perfectly fine. And so you basically take this and then you have an Aave, you have like a DAI market, and you just stick the DAI in there, right? And then at the moment that somebody wants to borrow that DAI, at that moment, that DAI is now collateralized by the ETH or whatever that they have in Aave. So yeah, it's kind of just like doing things backwards. It's interesting, but it fully works this model. And actually, this model comes up by a number of different names over the years. Like Frax would call this AMO. Like it's all the same thing, but it's really this: once you are the issuer of a token, you can mint it at free will, and then you can just stick it anywhere else in the market. And this has a number of advantages. And I think this is actually something that is quite unique to specifically on-chain stablecoins that doesn't exist in TradFi. Or maybe it does. I don't know. As far as I can tell, it doesn't exist. This is one of the very cool things that blockchain enables, and it kind of gives you a superpower. Now, anyway, so the D3M module, this is what it was basically. And then so it's like you're able to generate, or you get the yield that's coming from the Aave market. And so when we launched Sparkland, if we were to just launch a lending market in isolation, it suffers the same problem that everybody has, is that how do you attract liquidity? You need to find LPs, and then you need to find borrowers. You have to find both sides of the equation. But because Maker was already so big at the time, you can just you can have Maker LPing into the protocol right away. And so this solves one side of the equation. And this is how Sparkland was able to grow so fast. Within even a year, we were the second largest lending market by TVL. And it's precisely because once the market's there, you can have 100 million liquidity right away. So a borrower can come in like a huge whale or whatever and just borrow 100 million DAI right away. And so this is how it grew so fast. Anyways, so this pattern of D3M, AMO, whatever you want to call it, the Spark liquidity layer is just the most generalized version of that. And so it's some differences with the traditional one. The traditional one was using DAI. The Spark liquidity layer supports any asset. And that's important because not everybody wants to borrow DAI. Increasingly, they're like, good example of this is on Morpho on Base. The integration with Coinbase is only using USDC. So in order to plug into that market, we have to use USDC. But we have lots of USDC on the balance sheet, so it's not a problem. We can just take the USDC out of the peg stability module and then stick it in that market. And that's what the Spark liquidity layer does. So multiple assets, multi-chain, that's the other thing. We want to take advantage of opportunities wherever they are, as well as it's way more sophisticated in terms of automation. The D3M had so there's kind of two components of the D3M. There was the liquidity injection point that basically took the assets and then stuck them in the market. Very simple. But you also need a controller part, which is like, when do I add assets? When do I remove assets? What's the interest rate I want to target and stuff like that. So originally we did this on chain, but it required so much custom logic and stuff like that. And it was prone to, there's these weird edge cases where you could kind of manipulate it a bit, just with flash loans or whatever, stuff like that. So the observation was that, we don't need all this complexity on chain. Instead, we'll just have some rate limits. So you can only do things a certain amount at a time. And then we have all the logic off-chain. So we have, with the Spark liquidity layer, we have an off-chain controller which analyzes all kinds of stuff, including combining on-chain stuff, market conditions, basically everything you can think of that's relevant. And so by having all this logic off-chain and extremely complex and sophisticated, you can move the assets around. You don't custody any of the funds. They're all restricted in this Spark liquidity layer, but you're able to react much quicker and much more sophisticated to maximize the return that's being generated. And then the other piece of this is that because we don't have to write any custom code, and a lot of things are using standards these days like ERC 4626, adding a new protocol is actually as easy as a configuration change, which can be done on the order of a few weeks. what development cycles that would have taken, I think it was like 6 to 9 months to do a D3M before. Now, if people are using standards, and most are, it can be done in like a matter of weeks. Yeah. So yeah, that's more or less how you can think of the Spark liquidity layer's evolution from the D.
Interesting. And I think that is also part of what I see as this maybe broader evolution of the protocol, where as this kind of, MakerDAO / Sky generally as this like Federal Reserve or central bank of crypto, it now is kind of in this capital allocation role to some extent, where the Sky liquidity layer as the commercial bank in this shitty analogy that I'm making, and I know no one's supposed to be called a bank, but this commercial entity, is now making these capital allocation decisions of how do we maximize our ability to both of the assets we have, and given that we are allowed to or able to mint money in this AMO D3M type of fashion. Is that a fair kind of framing? And do you see your role as like a capital allocator here as much as a product builder?
Yeah, I think that's dead on. And again, I'll caveat that it's not a bank. We're not a bank, but like I think it's a very useful analogy. So Sky, yes, is converting into more of a central bank role where it's more concerned about bulk issuance of liquidity and maintaining the peg and sort of tail systematic risks, and less about any particular growth initiative. Do we deploy in market A with collateral B? These kind of decisions are what was grinding the DAO decision making to a halt previously, but they shouldn't even be that complex, right? It's like, so now all this decision making is moved into the SubDAOs. All of them can borrow from Sky. Interestingly, they can actually borrow as much as they want, as long as they're paying what's called the base rate that Sky charges. They can borrow as much liquidity as they need and then inject it to whatever opportunity that's available. And assuming these opportunities are the interest rate that you're earning is higher than the base rate, you pocket the entire spread as the SubDAO. So it's sort of a net interest margin business, similar to what commercial banks do. And so, yeah, our role is basically to find all these opportunities. And I still think we're only scratching the surface. Like access to there's newer things coming online all the time. I think like last year, Athena was a good example of something we did not have access to before, which is a safe way to access the funding rate in centralized exchanges. And innovations like segregated custody, which weren't around in 2022, a lot of these cash and carry trade businesses are keeping their assets off the exchange precisely because they're concerned about hacks and stuff like that. So these sort of innovations make these constructions much, much safer these days. And so now we can tap into that. But also there's like a lot of stuff. So we're pretty constrained to Ethereum land where there's, we've got a good chunk of the market of borrowers who want to use ETH as collateral. But still the exposure to Bitcoin is not that high. There's not necessarily that many people who are big Bitcoin OG whales who want to come onto Ethereum and, use Coinbase BTC or whatever else and borrow on Ethereum, right? They may be more Bitcoin maxis. So finding ways to meet these users is an important part in what the Spark liquidity layer enables us to do at a much more rapid pace.
Yeah, I mean, at least on the expansion of USDS specifically, I think right now outside of Ethereum, the largest supply is on Solana.
Yes, that's correct.
Did that kind of surprise you at all, just in terms of where there's demand for some of these products? I mean, you guys are also on Arbitrum and Base with USDS specifically, and it's much smaller than what we've seen in Solana.
Yeah, so I would say Base is actually pretty close. The amount of supply on Solana is about like 115 million, and the Base is like just a little under 100 million. So they're actually pretty comparable. Another thing is that the Solana allocation actually launched slightly before the Base one. So Solana was in September of last year. Base was in November, but we really started ramping it up more towards like end of December, early June, or January rather. And Arbitrum, yeah, it's about 15, 20 million right now, but like we just launched this like 3 weeks ago. So, it's kind of in line with just how long these have been online. But these are the big three. So I would say I expect them to be roughly comparable in size, and the growth just comes like integrations are a big part of that. And that's why you have this kind of growth just by being around longer, because it gives integrators longer time to integrate, more, they see more liquidity, they're more willing to integrate. This kind of feeds on itself. Yeah, I mean, not really surprised. Solana's a big market, and I think it's here to stay. So we should be able to offer the users of Solana savings rate, same as in Ethereum land.
Yeah, I mean, just in terms of integrations, I just had tweeted yesterday, actually, looking at some of the USDS yields across other protocols. It was like, the savings rate today is 5, I think. On Compound, you could get like 5.5. On Yearn, 8. On Euler, I think it was upwards of 10. So lots of great places to earn. I mean, I think the form factor of USDS is just simply one of the most straightforward things in all of crypto. So, overall, very great product. Okay, I want to talk a little bit about kind of the relationship between Spark and Sky. But before that, I want to come back to something you mentioned earlier as it related to Tether, payments, and that sort of stablecoin battle. I feel like, maybe 2 years ago, everyone was very set that the opportunity to displace Tether still very much existed. And today, I think the sentiment you gave, the sentiment that I hear generally is that, okay, Tether has pretty clearly won payments and some of the like inter-exchange volumes, all of this Tron supply, etc. Do you think that is the case? Like, are you mostly, I don't want to say giving up, but kind of relenting on pursuing some of that? / where, if there was going to be a wedge into some of what Tether's use is today, do you see that opportunity? Without giving
definitely
away all the
not
secrets.
giving up. Like we're going to be always pushing on multiple fronts. But yeah, I mean, I think it's important to know what your strengths are and not be focused on things that are not your core competency, which to me, we are at the top position in what is going to be the broad banking system of the next iteration of finance, which is blockchains and DeFi and all this kind of stuff. So Circle and Tether, they represent onshore and offshore dollars. And I think both of those products need to exist. I think Tether, if nothing else, is a good check on I think it was actually a great check. And in 2023, when we had the banking crisis in the US and Operation Choke Point 2.0, the US government was actively trying to crush crypto. And so who did they hurt the most? It's Circle, like the USDC. And what happened, right? There was a reaction and people fled USDC and they went into Tether. And I'm fairly certain the government is watching this and realizing there's no crushing it. All you can do is drive money offshore. And actually, that's a worse outcome. What their order preference is first, they would like to crush it. Okay, maybe the previous administration, not the newer one, but like previous administration was trying to crush it. That was very clear. But if they can't crush it, then their next preferable situation is probably that it's onshore. And so a favorable regulatory framework is, personally, I think Tether is, especially in a high interest rate environment, is perfectly safe. So it would be nice to have like more insight into their balance sheet and stuff like that. But in a high interest rate environment, I think like they're holding T-bills mostly because that's easy money and there's no reason not to. But if nothing else, there's also this check factor on the US government. And so that I think is a great reason to have both. Now, the next thing is, so both of these are stable coins in the sense that they are a full reserve backed by, cash, bank deposits, treasury bills, stuff like this. Basically, they're full reserve. And so that means that they can only hold different assets on their balance sheet. But it also means that if they were to even forward their yield, which they don't, they could only offer the treasury bill rate, or basically the risk-free rate. That is a fundamentally different product than more of a broad banking, where the liquidity goes down a bit, but you can kind of hit this sweet spot where you can get a lot of pretty good return without sacrificing too much liquidity. Exactly where USDS's strong point is as a more of a broad bank. Again, it's not a bank, but it's like it is a fractional reserve stable coin. So you're able to do lending like CDPs and stuff like that, and those will, especially during bull markets, will yield higher rates of return than treasury bills. And so having that flexibility, maybe not everybody wants that. That's fine. I think these are different products for different people. But I think and it's proven out, there is a large cohort of users who want access to this like pretty relatively safe yield that comes from the bull market behavior. And so USDS is able to provide that because of the different design decisions in its construction.
Yeah, I agree with all of that. One other question, I guess, coming back to Tether is, so today Tether's not a part of the PSM, correct?
No.
Would you ever consider it as a part of the PSM? Or would Maker?
Yeah, so we're definitely adding Tether support, but it's like the PSM is a very specific thing. You can think of it like a DEX where it's like a one-to-one swap. It's like the simplest DEX you can possibly construct. You can't actually hard peg yourself to two different assets because then you kind of just get wedged in the middle of larger market forces. So like the balance sheet, you would basically up to the debt. Let's say we onboarded a PSM for Tether and it was a 400 million debt ceiling or something like that. That PSM would either be empty or full. There would be no in between. It would either be empty or full depending on whether Tether was trading below or above USDC. And so, but your broader question is, will we supply primary market liquidity to Tether? And the answer is yes. And we're going to be doing that very soon. That's going to be important for people to get in and out of SUSDS and when they're in Tether. And so we want to support these users by providing more liquidity that has been neglected in the past.
Yeah, it's an interesting point too, just on Tether, which is that even though it is multiples larger than USDC today, within DeFi, it's not particularly prevalent compared to DAI, USDS, and USDC at least. So I know they just rolled out USDT 0, and I saw that Inc. seems to be kind of standardizing around that for their layer 2 rather than USDC. So I don't know. We'll see. I think there could be some interesting opportunities there to be looking out for.
Yeah, I mean, about USDT 0, this is actually a very huge development for us and increases our usage of Tether within the ecosystem. Circle is a little bit ahead here in that they've developed a Circle cross-chain transport protocol, CCTP. This is their native bridging. We're a heavy user of that with the Spark liquidity layer because this enables us to move USDC cross-chain in huge size. And I think with bridging, the term is like extremely overloaded. So I think there's some confusion. Some people are like, oh, there's been cross-chain swaps of tokens for a while, right? There's all these like liquidity network bridges. The problem with those is that when you reach a certain size, these use third parties for liquidity, and you grow too big to support these liquidity networks, and things like fees just become infeasible. The most preferred solution is that you have a native bridge that can do any size basically, and that's what Circle CCTP is. We use that. We don't pay any fees, and we can move from Base to Ethereum to Arbitrum to Solana at any size. We're still like doing like maybe tens of millions now, but this will be eventually hundreds of millions. We will probably be one of the largest users of Circle CCTP fairly soon, if not already. And then the same was with Tether. So Tether previously did not have a native bridge, and USDT 0 is its native bridge. There are some subtleties there. I don't know how much you want to get into the weeds on this, but it's like USDC has like native minting on their token. As USDC 0 facilitates liquidity between the native USDT on each of these chains. So there are some differences, but overall, like we really like this move from Tether because it frees us up from once we start getting Tether onto the Spark liquidity layer balance sheet. We're able to we're not just constrained to Ethereum to deploy that. We can now deploy it on all the chains that's being supported by
Great. Yeah, nice to hear. I'm actually curious about coming back to some of those kind of cross-chain, maybe intent-based stuff later on. Before that, I'm curious about something else, which is that maybe like 2 or so years ago, around the time you guys were launching, it felt like DeFi was sort of ending its period of everyone is friends and things were getting much more competitive between different protocols. I think you guys and Aave was maybe where some of that began. Seems you guys are friendly now. They're focused on fighting with Morpho. But there was kind of this moment where it felt like everyone was starting to step on each other's toes, right? MakerDAO was launching a lending protocol. Aave was launching a stablecoin. Curve launched a stablecoin, et cetera, et cetera. And at the time, I had kind of wondered whether, Aave would have an easier time launching a stablecoin or whether Maker would have an easier time launching a lending market. And I think fast forwarding 2 years into the future, MakerDAO's ecosystem has done that much better. What is the result of, how do we get to that point? Is it that Maker's kind of structural capital advantage was able to jump Spark so far ahead of everyone else? Or how do you kind of see those competitive relationships between some of the protocols today?
Yeah, and so I first of all, I don't think this is unique to DeFi at all. I think it's just business.
Yes, markets, yeah.
And there's always this like collaborative, competitive, and like dichotomy. And like it exists. So like, what I personally am more interested in is growing the pie, because like I think yes, there's we're going to be competing and stuff like that. I'm not just going to lay down and let everybody do whatever they want, but like I am more interested in growing what the available total addressable market is, because I think we're just like so early and like there's just not that many people on chain. So whether we're first or second or third or whatever, it's much better for everybody if the pie is just way bigger, because then everybody's winning. So that is my number one goal. But yes, of course, there's competitive nature. And with something like DeFi, it actually makes sense to occupy pretty much every vertical. There's no reason not to, because it's open source code, things just become more and more efficient. I think everybody's just going to do this. I don't think there's anything, you see it like every protocol is launching every other product. Really where the edge is, as you mentioned, is network effects liquidity. That is by far the biggest one. And it's also why, Tether's doing so well, is because they were first and they're doing a good job. You have to be first, you have to do a good job, and like you can still fuck up and somebody can take your place. It's not like it's set in stone forever. Liquidity network effects are a huge factor, and it's really hard to fight against that, especially if you're like a newer entrant. So yeah, I would say things like liquidity and brand are some of the most important things in the space. But yeah, we want to work with everybody to as much as we can, and I think there's more ways to work together than rabid fighting, a zero sum style. But it's a trade off like any business.
Yeah, and I think you guys kind of exemplify that well today with just the Spark liquidity layer generally, right? You sort of enable all of these other protocols with all of the liquidity you can provide. But speaking of that, and Sky and Spark's ability to sort of king make some other protocols, the Spark RWA Grand Prix, I'm messing up the name, just concluded. I wasn't following it too closely, but when I saw the results, two things struck me. First thing struck me was that it was crazy to me that there was 39 applications. I had no idea that there was that many protocols. The second thing was that if I had paid more attention, I probably would have guessed at least two of the winners. I probably would have guessed Biddle, and I probably would have guessed Superstate. And Centrifuge probably would have been in my top 5 guesses. I don't know if they would have been my third, if I'm being honest. What that made me think was that the competition in that market feels off, where it feels like there are these super regulated products, the Biddles and the Superstates of the world. And I guess you'd put the Centrifuge one in that bucket as well. Then there are the ones leaning more into the kind of degen side, you could say, like a Usual that has all of these kind of games and points and things you can do around the stablecoin. And then there's just like this middle ground of 35 other issuers or whatever that don't really have a lot of differentiation. How do you see that kind of RWA market generally, or kind of T-bills specifically?
Yeah, I mean, T-bills in particular are heavily commoditized, probably one of the most commoditized RWAs you can get other than the US dollar. So clearly there's not going to be a huge amount of differentiation. Like the competition was mostly run on like fees and, brand stuff like that. We want like good partners,
legal protections, I assume.
Yeah, of course. But yeah, it's a very commoditized asset. So like the T-bills in and of themselves are not like that interesting. They're just like, you want the yield on your cash, so that's where you go, right? It's like the default. But what I view it more as like a first step. And what we'll see more and more is moving out the risk curve. Now that we've got this foothold, people are getting used to it. You've got the biggest institutions involved, like BlackRock. This is just the beginning. So I see stuff like next, I think fairly soon, we'll see sizable amounts into like CLOs, stuff like that. But eventually, this might go all the way up to private credit. So yeah, I view this as the start. But yeah, the amounts are pretty huge. Like the Grand Prix was for 1 billion, but actually current market conditions, if they don't change, it might be closer to 3 billion being deployed, just because there's a lot of excess cash in the market right now because of the market has crashed. But yeah, it's a good tool in the toolbox. And this is actually closing out one of the areas of Maker that I've been very interested in, which is we don't want to just like move the finance system online or on chain and then like do no improvements. There's a huge improvement, which is the transparency and auditability. For me, RWAs should be these very simple constructs that sit at the edges of the blockchain. This represents T-bills. This NFT represents a house, or like something like this. Like just the most primitive possible things that sit at the edges. And then we can drag all the loan supply chains craziness that is very opaque in TradFi and leads to things like the financial crisis of 2008. It's largely due to opaqueness, and people just didn't have any transparency into what all this like crazy constructions were. Bring all this on chain, and so that it's like fully transparent and auditable in real time. Doing analysis, especially in the age of AI, anybody could do that. And they can be like, what's backing this? And like, you can really drill down in the way that Michael Burry did in the 2008 event. He had to like dig into all this stuff. But if this is like radically transparent, people can see where these systematic issues are. And this is where we want to improve on the system. And this is where Sky is an improvement in my view, because you can go to info.sky.money, and there still is the portion that we're unwinding that is off-chain treasury bills that's being moved into the Grand Prix. Once that happens, almost the entire balance sheet is in these like primitive constructions. And so you can see exactly where everything is, right out to hard assets.
Yeah, I think something else that, and I just caught part of the spaces you did yesterday or the day before on the Grand Prix. And I guess, if I look back at some of MakerDAO's RWA investments in the past, there was what I call like experimental private credit stuff with Centrifuge that has not done well. Just frankly, I think a lot of them have gone to default, but very small amounts. And then with T-bills, I think they've been kind of controversial in just that, given the very off-chain nature of them, they've been expensive from a fee perspective. I think Monetalis had like very large fees. Block Tower had relatively large fees for what were T-bills, I think. And what's cool now is that the current products you're using are more on-chain, and you're just like you're a large investor in these products, but just one of many. And so, you get to benefit from the fee competition rather than people offering bespoke things with higher fees to you guys. So I think that's actually a great aspect of this whole thing too.
Yeah, I mean, 1,000%. Like back in the day, the experiment of private credit, was exactly as you said. It was an experiment, but there's a huge adverse selection there where people were just coming and pitching their random crap, and of course, it didn't go that well. It wasn't a large amount, so yes, there were some losses, but in the grand scheme of things, it's peanuts. So I think the experiments that were run back then, some of them failed, but some of them were successful. So yes, there was large fees on some of the original structures of T-bills. But it's more I'm the view, get it done 90% of the way, make sure it's good enough, because the opportunity cost was crazy, especially as the interest rates started going up. The opportunity cost was obscene. We're talking hundreds of millions of dollars if you didn't get it done. So getting it done, and maybe it's not the most capital efficient thing in the world, but you have a first version. And now we spend iterating, and then we get to this place where we have modern tokenized T-bills where they're competing on the fees. Now we have something that's 98% of the way there. So that's much better.
Yeah, very much so. So as we're coming up on time here, I have maybe 2 or 3 things to wrap up on. One is something that I've kind of been curious about, which is that in the shift to the SubDAO model, I think Sky is really the shining star. Spark is really the kind of shining star. And as you guys are coming up on your token launch, I'm curious what value capture looks like going forward, kind of between Sky and Spark and other hypothetical future SubDAOs. In some level, I think you guys will own a lot of the customer and user facing behavior of the ecosystem kind of going forward. So how does that break down from fees and hypothetical revenue?
Yeah.
And if you don't know the answer, it's okay too.
No, I know the answer. So right away, and this is actually coming up fairly soon, as you mentioned, the token launch is quite soon, and we'll be launching the Spark for real. We've been in this interim phase where all the revenue is going back to Sky. Sky's funding everything, but we're going to reach this point very soon where the SubDAO is truly thrown off on its own. We get some startup capital, but we're actually going to be making money right off the bat, because as I said, the business is that Sky will be charging a base rate, and that base rate is market dependent. So right now, the base rate will be around what just under what the treasury bill rate is. And so right away, Spark is able to deploy all that excess capital into treasury bills, these tokenized T-bills. And then it's not the most margin, but it's a huge amount of capital. So Spark will be making that spread. But then additionally, the Sparkland market, which is still a 3 billion in deposits, it's quite large. So Spark is also entitled to make the spread on the market there. That is anchored to be, right now it's 50 bips above the savings rate. That will be adjusted. But yeah, it's 50, 100 bips, but on a pretty sizable amount. So the revenue right off the bat is going to be quite large for what I would say is kind of like a startup. So yeah, we're going to have capital injection, revenue, and probably even profitable right off the bat. This is the opportunity is quite big. And then we're working as fast as possible, fast and safe, to deploy capital into all these new opportunities that I mentioned. I think Bitcoin is fairly underserved right now. That's a pretty easy market to get into. But now we also have access to the funding rates. So if the market goes nuts again, we can just put a whole bunch of capital into Athena, and Spark is earning that spread. That's a massive spread. Of course, that's going to come down over the months, but I think right now, there's a very big opportunity. And for Sky is reinvesting most of everything into growth. So Sky does make a small margin, but the thing is Sky is most focused on is growing the size as much as possible. So it's stepping on the gas in terms of funding these SubDAOs to do growth and innovation, but then not taking even all that much margin between the base rate and the savings rate that it provides.
Yeah, makes sense. Well, I guess that's my kind of closing question here. So you said Sparkland today is about 3 billion in TVL. What do you think are the next big sort of drivers for that, or what is kind of Yeah, well, what's the next big driver for growth that you see for Sparkland?
Yeah, so 3.7 billion deposits, to be clear, not
In deposits, yes, of course.
Yeah. So what is the next big growth driver? I think it is institutions. I think they're getting more and more comfortable coming on chain, and especially with the change in regulation and regulatory clarity with a lot of the crypto stuff. I think we're going to continue to see more institutions coming on chain. So these will be big users of Sparkland. But furthermore, they don't have to come on chain. This is the thing that's changing. Like, so as of April 7th, we'll be integrating Maple's Syrup USDC product, which is off-chain lending against Bitcoin and ETH and LSTs and all this kind of stuff. So they can have their own custodians and stuff like that. Previously, we couldn't cater to these users directly. Now we can. So onboarding basically all these new options for borrowing is what's going to grow Spark as a whole. So Sparkland, yes, that's important to grow. But I think the more important thing is just to grow the Spark as a whole. And that means deploying more capital and improving the APY on that capital.
Awesome. Well, we'll be looking out for all of that. Where can people follow you, follow along with everything that's going on with Spark?
Yeah, you can follow me, Hexanaut, on Twitter, and there's Spark.fi Twitter account, which is all things Spark. And there's going to be lots of cool campaigns that are coming up soon leading into TG. So I recommend following the Spark account if you want to get more involved at the ground floor.
Awesome. And also, as a reminder, you can access many of Spark's best yields through app.vaults.fyi as well. So please do check that out. And yeah, Sam, thanks for all the time today. Always a pleasure to talk.
Yeah, thanks for having me.
All right. Talk to you soon.